Welcome to the boardroom. I am your managing director for today's audit, and we are stepping right into a rigorous C-suite grade proposal scan for your Cambridge 9706 accounting exams. Look, we're going to treat your next exam paper exactly like a multi-million-dollar corporate pitch. We're specifically targeting a major liability area that systematically separates the entry-level interns from the top-tier executives, and that is the architecture of capital versus revenue reserves, with a laser-focused audit on share premium and revaluation reserves. Today, we're decoding the exact structural frameworks, the raw data analytics, and that high-level evaluative reasoning that tough Cambridge examiners absolutely demand before they sign off on your grade. So, grab your notes and let's get down to business. Our itinerary for this session moves systematically. We'll start with the boardroom briefing, run an asset inventory of our core principles, implement our standardized processing methodology, conduct a ruthless liability audit based on real examiner warnings, elevate your response with the executive pitch, and finally lock in the strategy in securing the deal. Section 1. The boardroom briefing. Let's establish our market opportunity. Mastering the complex framework of capital and revenue reserves isn't just some optional module you can skim over. This is a mandatory, high-stakes topic that appears in every single Cambridge exam series without fail. Whether you're extracting data for a multiple-choice question or building out a massive, high-tariff structured written response, you have to have a concrete, bulletproof understanding of how an account like share premium operates versus your standard retained earnings. Now consider that $1 million figure your executive value meter. Hitting this maximum valuation, which translates directly to that coveted Band 1 A-star mark level on the Cambridge rubric, requires you to completely abandon superficial breadth. You literally cannot just walk into the exam, list a few basic facts, and expect a premium payout from the examiner. They reject poorly framed proposals instantly. Instead, the assessment framework strictly prioritizes high-level analytical depth. They demand that you understand not just what these reserves are on paper, but exactly how they function and breathe within the broader financial architecture of a limited company. Section 2. Asset Inventory Core Principles. Let's audit our core academic assets. The theoretical architecture of your proposal has to rest on incredibly precise definitions. You have to clearly distinguish between capital reserves, like your share premiums, and your day-to-day revenue reserves. Now, to picture how this usually goes wrong, I want you to imagine two junior consultants pitching a response. Let's call them Alex and Sam. Alex is our data-heavy associate. Alex wants to walk into the exam and just dump every single dictionary definition of a share premium onto the page, meticulously explaining that it's a capital reserve, created when shares are issued above their nominal or par value. But Alex fails to evaluate the actual market risks or applications. Then there's Sam. Sam speaks incredibly fast, pitches brilliant creative concepts, and just wants to skip the boring definitions altogether to talk about how the company actually spends its money. Sam lacks the hard asset backing of specific accounting frameworks. Listen to me, both of these approaches will fail in isolation. To secure that maximum executive value, you have to merge them. You must definitively, explicitly state that capital reserves, again, your share premium, your revaluation reserves, arise from non-trading activities. That means issuing shares at a premium or the upward revaluation of non-current assets. And crucially, you have to highlight the legal constraint. They cannot normally be distributed as cash dividends to shareholders. In stark contrast, you define revenue reserves, like retained earnings or general reserves, as being generated strictly from standard day-to-day trading profits, making them legally distributable as dividends. Establishing this binary difference right out of the gate is the foundation of your entire pitch. But here is where you separate yourself from the pack. The principal examiners have explicitly noted that candidates who integrate these definitions with causal relationships across other syllabus areas yield a massive return on investment. Our consultants, Alex and Sam, need to realize that a revaluation reserve absolutely does not exist in a vacuum. It's an ecosystem. It connects directly to your depreciation schedules, it connects to the disposal of non-current assets, and it massively impacts your statement of changes in equity. When you can show the examiner exactly how a shift in a capital reserve ripples through the entire financial bloodstream of a business, that is when your executive value meter skyrockets. Section 3. Standardized Processing Methodology. Time to implement the SOP. We need to capture every single available method mark. This is where your valuation is driven by the sheer logic of your process. Even if your final mathematical calculation has a slight glitch, you have to follow this exact sequence to maintain compliance. Step 1. Identify key elements. You systematically deconstruct the prompt and extract the raw stimulus data. Ask yourself, is the board asking about a bonus issue of shares utilizing the share premium account, or is this a rights issue?
Step 2. Apply relevant principles. If it is a bonus issue, your corporate strategy should be to utilize your capital reserves first. Why? To keep your revenue reserves fully available for future dividend payouts, to keep shareholders happy. Step 3. Execute analysis with clear working. You leave a trail. Show every single calculation line by line. Step 4. Verify your results. Do a compliance check. Do your debits and credits balance? Does the equity section reflect the new reserve balances accurately? And finally, Step 5. Present in the appropriate format using strict corporate terminology. Do not ever write the extra share money on a Cambridge exam paper. It is the share premium. Period.
Section 4. Liability Audit. Examiner Warnings. Let's scan for vulnerabilities. We're diving into the principal examiner reports, and our liability audit has uncovered 3 massive structural exploits that will cause your valuation to crash straight to the bottom of the marking grid. Exploit number 1. Vague answers lacking detail. If you are asked to explain the use of a revaluation reserve, and you just write it's for revaluing assets, that is a low-value, descriptive text block. It's not a pitch. A C-suite response specifies that it records the unrealized gain on the upward revaluation of non-current assets to represent a true and fair view of the company's current financial position. Exploit number 2. Completely dropping your formatting standards. This happens all the time. If the examiner requests an extract of the statement of financial position, and you hand them a basic T account, that is a fundamental breach of regulations. You're losing points on presentation alone. And exploit number 3. Failing to anchor your pitch to the specific context provided. If you have a case study about a manufacturing firm facing a severe liquidity crisis, and your proposal suggests they should just pay out all their revenue reserves as dividends without once analyzing their actual cash flow, you have entirely failed the context audit. Okay, before we push this response into top-band valuation territory and show you how to seamlessly secure these points, I need to make sure your personal academic assets are properly managed. If you want to keep securing elite grades, subscribe to Ace the Exams right now and turn on all notifications. Whether your focus is Cambridge IGCSE, O-levels, AS, or A-levels, consider this channel your weekly board seat. Now back to the audit. Look at this critical, red-level examiner alert directly from the source. Quote, candidates consistently confuse key terminology. Always define terms before using them in extended responses. Never, ever assume the examiner knows what you mean. If you're pitching high-level strategic concepts but you're getting sloppy and using the terms capital reserve and capital expenditure interchangeably, that triggers an immediate valuation downgrade. Explicitly defining your terms before deploying them in your argument is your ultimate defense mechanism. Think of the Peel framework. Point, evidence, explanation, link. That point must always be anchored in a precise, Cambridge-compliant definition before you build the rest of your paragraph. Section 5. The executive pitch evaluation. Let's elevate this proposal. We are now transitioning from a basic answer into a high-value executive analytical pitch. Higher-order assessment objectives demand that you climb this exact matrix. Look at column 1, descriptive, your basic knowledge. This is literally just identifying the given information, noting that a company has a share premium of $50,000. That is just standard data entry, and it yields a minimum return. Move to column 2, analytical. Now we are deconstructing and solving. We take that $50,000 and break it into logical steps. You explain to the examiner that the company can use this $50,000 share premium to fund a bonus issue of shares. You explain this successfully turns a capital reserve into permanent share capital without draining any actual cash liquidity. That secures you a solid, respectable mid-level valuation. But column 3 is the boardroom, evaluative. This requires you to assess alternatives, limitations, and underlying assumptions. To get an A-star, you have to evaluate the quality of the action. A true executive pitch sounds like this. While utilizing the share premium for a bonus issue preserves cash liquidity, which is a major strategic advantage for a firm currently facing constraints, we must acknowledge it also increases the total number of issued shares. This action may dilute future earnings per share and will place significant pressure on the company to maintain its dividend payout rate from revenue reserves in the next fiscal year. Do you hear the difference? The information is identified, the action is analyzed, but crucially, the future limitations and alternative interpretations are ruthlessly evaluated. Let's run a live compliance audit right now. Mentally extract the data point here. Look at how the market accumulation is structured. As you can clearly see, top-scoring candidates max out their value meter specifically because they justify their corporate decisions with hard evaluated evidence. Knowledge gives you a low return. Analysis gives you a medium return. But evaluation shoots that meter all the way to the maximum A-star level. Every single numerical problem in these 9706 accounting papers relies on a strict loop. Deconstruct, solve, evaluate. You systematically solve the math, you check those findings to see if they are actually commercially reasonable, and then you make justified recommendations based entirely on that specific company's financial standing. Questioning assumptions like pointing out the radically different impacts a policy might have on both physical cash flow versus equity structure, that is exactly what demonstrates your true readiness for the boardroom. Section 6. Securing the deal. Let's wrap up this audit.
To maintain this executive edge and ensure you're always operating at maximum compliance, you need continuous academic asset management. The source material heavily emphasizes that engaging with educational platforms that continuously audit the syllabus, specifically ACE the exams, is your primary vehicle for accessing these high-value analytical breakdowns. Subscribe to ACE the exams right now at ACE the exams and hit that notification bell. This is how you optimize your overall exam performance and secure your elite grades strategies week after week.
Let's adjourn this boardroom session with a final check of your specific portfolio. Drop a comment below right now and state your target grade, your qualification tier, and your subject. Put it on the record. And let me ask you one final question. Now that you understand the massive difference between a low-value descriptive summary and a high-value evaluative pitch, are you ready to structure your very next exam answer with the ruthless precision of a C-suite executive proposal? I'll see you in the next session.